Hi everyone, it's iCurlyK here, and today we're going to be discussing the various forms of support and resistance. And because time is money, let's get right into it. When it comes to trading, support is almost like saying the floor, whereas resistance is almost like saying the ceiling. And to help you remember, consider all of the candlesticks on your chart as people inside of a home. The floor offering support for you to stand, and if you jump to your highest point and hit the ceiling, it should offer you a level of resistance. Any levels below the candlesticks is support, and above the candlesticks is resistance. The key to locating areas of support is to pay attention to areas in which price action has had a similar reaction on two or more occasions to a certain level. The more reactions, the stronger the level. However, if there is a strong presence of sellers, it can actually cause us to break down below the area of support. Without the seller pressure, we have the potential to hit and then bounce to the opposite direction. The key to locating areas of resistance is to pay attention to areas in which price action has had a similar reaction on two or more occasions to a certain level. The more reactions, the stronger the level. At this level, we have the potential to hit and then reject to the opposite direction. However, if there is a strong presence of buyers, it can actually cause us to break out and above that level of resistance. Support and resistance is a roadmap for historical data, which allows us to prepare our minds for what has the potential to happen in the future. Your thought process should be, the last time we got close to this level, we had a reaction that prevented us from going higher or lower. So there's a probability that it may happen again in the future. Now, let's go ahead and jump right into some actual charting. All right, so first things first, when it comes to mapping out levels of support and resistance, a rule of thumb is that you always want to pay attention to the most recent candle because you are trading for the future, right? You're not trading in the past. All right, so when it comes to this particular candle right here, it is the end of the month. So this candle is 100% closed. So what I want to do is I want to first pull out any levels directly above this particular candle because I want to know if we continue on this uptrend that we're currently in, what could be a potential stopping point. So I'm going to look straight across my chart. It's a great thing that TradingView actually has grids on the chart, so you can see these little lines here. Very great thing to use. But what I want to do is I want to look straight across my chart. I want to look above this particular candle here, and I want to look for any areas that could potentially stop me along the way. So one level that I can actually pull out because this candle is closed is going to be, let's see here. I'm just going to roll it right up here. And I do kind of like this position right here, and I'll tell you why. I see that on this month, we actually stopped at this level. So we bounced to the upside here. We bounced here as well as here, but right below this, and keep in mind, it can be above or below. You're just looking for areas where we had a reaction to in the past that we could potentially have again in the future. So right here, we actually hit this level and rejected as well. We hit here and rejected. So this to me looks like a pretty good point of resistance. So what I would assume would happen is that as we navigate our way up, we could essentially hit this particular point and pull back. Now, like I taught in the video already, we can blow through that level, but it's going to require an extreme level of buyer support to actually step up to push us through that particular level. So I'm just going to make this line a little bit thicker, and I'm going to turn it white so that we're able to identify, our colors as we navigate our way through time frames. Now, because I want to do a little bit of the homework because we are so close to this particular line, I want to figure out what could be our next stopping point. And I see this one right here. The reason why I see that as a stopping point as well is because we hit here on this particular month and we hit here as well. So I'm not going to drag it all the way up and knock out too many levels of resistance. I'm going to actually look below the current candle for any levels of support. So if I look below this particular candle and actually just kind of navigate my way straight across, then I can actually see that, yeah, I can actually map this as a level of support. Okay, so that will be my level of support. Now I'm going to expand this, and I'm going to also talk to you about a few things. Although we have the closest area of resistance above this candle and we have the level of support below this candle, we also have to keep in mind that this candle closed right here, right? So there's still going to be an area where it could stop right here. It could stop right here. I'm just, pulling out random things. So we actually have to fill in the blanks. I guess that's what I'm saying. So now if I look straight across my chart, I can actually see that this may be a level as well. Although this candle didn't hit it quite, 100%, it's relatively close. And that's more than likely the reason why we closed at that point. And then I'm going to work my way down and see if there's anything in the middle here that could stop us along the way as well. So I'll scroll my chart in. All right. So on the monthly time frame, that's about all we have to pull out. Now, one other thing that is very important is going to be time frames. So I'm actually going to drop a video on time frames so that you know what are the best time frames that you need to map out your levels of support and resistance. So obviously, if I'm on a monthly time frame, then I'm looking a little bit longer out, a little bit further out. If I wanted to pull out my areas of support and resistance because maybe I want to day trade, then maybe I will map it out the same way, but around the day. Hopefully that makes sense. So essentially, you're looking for areas where we had a reaction to on 2 or more occasions. The more reactions, the stronger that level, because it's more reinforced. So hopefully this helps you, and let's get right back into the lesson. Trend lines are another form of support and resistance, but it requires you to train your eyes to see them. What you want to do is look for at least 2 connecting points that if you were to attach a diagonal line to, the candles would respect and not break. When you notice candlesticks are moving in a clear direction and then suddenly starts to pull to the trend, unless it breaks the trend, you can actually consider holding your position. Once the trend is broken, it can signal that it's time to get out of the trade. For an uptrend, the trend line is drawn below the candles, offering a level of support. And for a downtrend, the trend line is drawn above the candles, offering a form of resistance. All right, let's get ready to knock out some trend lines. All right, so let's go ahead and get right into mapping out our trend line. So this one right here is actually going to require you to train your eyes. So you're going to have to practice this before you're actually comfortable in doing it right. So the very first thing that I want to do is I want to say to myself, if I were to map out a diagonal line, how many candles would actually touch this line and respect it? And the reason why I want to do that is because it basically lets me know that as long as we are bouncing off of this trend line, I can remain in my position. But if we see something like a reversal candle, which is something that I taught in a previous video on my YouTube, if we see a reversal candle and then we start to break below the trend line, that could signal to actually get out of that particular trade. And if you also want to think outside the box, you can actually map out a trend line. And when you see a trend is broken, you can actually take that position into the opposite direction. So I'm actually going to attach it to this candle. And I would say this one looks like it could connect pretty well. So I'm just going to connect it here and then there, right? So now, as you can see, we have price action that is really just following this particular trend. But guess what? Let's say, the next month comes and we actually push to this particular trend. Unless we break it, especially if I was someone who got in way down here or anywhere in this zone, I can say to myself, well, we may just be cooling off so that we can continue to push to the upside. Okay. So again, when you're mapping out trend lines, it is important to know that for a bullish trend or a trend that's moving to the upside, you're going to map it out below the candles because it is going to form as a support level. Okay. And then when it comes to mapping out trend lines, to the downside, you're actually going to be doing that above the candles. And as long as, and let me give you a good example here, as long as price action, as you can see here, we push down, right? And then we actually pulled back to the trend. We pulled away. We pulled back to the trends. We pulled away and pulled back. As long as we're constantly, bouncing away from that particular trend and we're not breaking it, it could basically let you know to stay in a little bit longer. And then when you see price action starting to, maybe show signs of reversal, and then we actually crack that trend, that could alert you that the direction is changing overall. So I hope this helps. Go ahead and practice your trend lines. And trust me, we are going to discuss time frames to use your trend lines or to map them out. We're going to discuss time frames in general. So I hope this part helps, and let's get right back into the lesson. Broadening formations are another form of support and resistance. It represents expansion of a range, and it's also a great indication of potential exhaustion risk. To locate the top of a broadening formation, simply look for a point at which it went to its highest and then reject it immediately after, and then a lower high at which it rejected immediately after, and attach the upper broadening formation to it. For the bottom of your broadening formation, you're simply looking for your most recent low, which can be found near an area where we bounced immediately after, and then a higher low where we bounced immediately after. And attach the bottom of your broadening formation to that. Broadening formations also indicates great buy or sell zones. Of course, you can always break out of a broadening formation, but it's going to require an extreme level of buying or selling pressure in order to do so. One quick tip to remember when mapping out broadening formations is that it takes on the shape of a megaphone. All right, so now let's discuss broadening formations. To assist with this particular pattern, I wanted to just point out that it looks like a megaphone. So sometimes I see people map out their broadening formations this way, right? And that's not right. It actually has to have a higher point and then a lower high in a sense, a lower point, and then a higher low. Okay, so just make sure that you keep that as a, general rule of thumb. Also, you can attach broadening formations. This is more strat talk. I have, covered this in previous videos, but you can attach your broadening formations to the candlestick that is a 3, right? An outside candle. And so to do that, I'll just make it, very simple, and I'll turn my magnet on so that it can snap. So I would actually attach it to the bottom of this 3. And again, I'm looking for, since I'm at the bottom, I'm looking for a higher, or actually a lower, a higher low, right? A higher low. So there we go right there. So just not to confuse you, let me say it again. I'm actually attaching it to the bottom of this 3 candle here. And then I'm looking back for a point at which it went low, but not as low as this lowest point. Hopefully that doesn't confuse you. And sometimes it does. And so that's one of the reasons why I have a different method for actually mapping out your broadening formations, okay? So first and foremost, I want to look for one of my most recent high points, right? I can include this as well, but let's just make it simple on ourselves, okay? So I want to look for my most recent high point, and then I want to look and see if immediately after that, did we push down? Because that's what I want. I want my most recent high, and then I want to attach it to an area where we push down immediately after. And then I'm going to attach my first point to that. But then before I do that, I want to also find another point at which we went high and then reversed immediately after that. So if your eyes are where my eyes are, I'm going to attach it here. And then I'm going to attach it here because, again, we went to this highest point and then pushed down immediately after. And then if I look back in time, we went high and then we pushed down immediately after that. Now, if you pay attention, although I use this point and this point, look at how our most recent weekly candles are actually respecting the top of this particular broadening formation. Now, broadening formations are a way of showing exhaustion risk, no different than your 52-week high and low. It basically says, hey, we are getting to a point where we're overextended. At some point, we may be looking to cool off here soon, all right? So that tackles the top of the broadening formation. So when it comes to the bottom of the broadening formation, I want to look for a point at which we went very low, and then reversed immediately after. So if your eyes are where my eyes are, I see that we went low here, right? And then we reverse to the upside immediately after. So I want to connect my first point there, but I also want to look back for a higher low, right? It's still going to have to keep this particular shape. I want to look back for a higher low at which we reversed immediately after. So these are my 2 points right here. Now, it's also very important to make sure that you're capturing enough candles as well, because remember, these points you want multiple candles to actually hit because it reinforces that particular level. So what I'm actually seeing here is, although I attached it here and here, look at how many candles actually do respect that particular point. Now, it is a way to view an expansion of a range. So you will also find broadening formations within broadening formations. So I can actually show you one here. So let's just, and I'm actually going to turn this green so that we know that once we get down to the bottom of the broadening formation, that is an indication that there may be buying opportunity soon. And then at the top of the broadening formation, I have that red so that you can understand that there may be points at which we may be able to sell soon. Okay. Not immediately. It doesn't happen all the time as soon as it hits, but just keep your eyes peeled because we are at the top of the broadening formation. Psychological levels have to be the easiest of all of the support and resistance. It's simply a reflection of how many of us have learned how to count in groups. And typically, major institutions have buy and sell orders set at psychological levels like 5, even groups of 10, 100, or even 1,000. With psychological levels, let's say price action bounced off of 90, which is actually a psychological level, and was able to blow through 91 through 94. And as soon as it hit 95, it immediately rejected into the opposite direction. This can sometimes be attributed to a psychological level, or psych level for short. High of day and low of day are also very simple. This is where price action has at one point reached its highest or lowest points of the day and then rejected, but at some point started to trend back towards either the high or low of day. And just like any other form of support and resistance, we can still blow through these levels, but it will require an extreme level of buyer or seller pressure. All right, now let's go ahead and talk about psychological levels. So this one is, in my opinion, very simple because we were taught in school how to count in groups of, 5, 10, 15, 20, or 10, 20, 30, 40, 50. I can go on. I can go through the tens, the thousands, but psychologically, institutions like to have, buy orders or sell orders set at psychological levels. They're probably not going to say, hey, sell this particular stock at 453 or anything like that. They may say 450 or 460 or 500, for example. So with that being the case, we do want to trade with the smart money all the time, right? But we also want to pay attention to psychological levels because it's not just institutions that look at those levels, it's actual retail traders as well. So it should be, very obvious to you that right around here in this range of like 420, as you can see here, right? 420.01, look at how price action just kind of bounces off of this, right? If you train your mind to think like an institution or like a trader, right? Because that's why we're all here, you should say to yourself, man, they really don't want it to break below 420. They're doing everything possible to keep it from breaking below 420. That's how we like to think when we're talking in terms of trading. And then if I look straight across my chart to the upside, right, this would be a resistance point. I see that there's a lot of congregating of candles like right at this range. And it's kind of obvious to me that that's the range that's getting us very close to 425. So hopefully you can see how psychological levels really do impact how we trade on a day-to-day basis. All right, so we all know that there are 4 parts to a candle, right? There's the open, high, low, and close. So let's pay attention to the very first 5-minute candle on this Carnival Cruise Line's chart. So when this particular 5-minute candle opened, this red one here, it opened right here. And then the lowest point that it actually went to is about 1763. Now, if we pay attention to the candle that came immediately after it, it opened here, right? Because the open, when it's a bullish candle, it's always lower than the close, right? Or below the close. So we opened here at 1766. But pay attention to our lowest point and how close it is to the previous candle. So I believe that's literally 1 cent off. So we literally went to the lowest point of the day, right? And bounced to the upside. All right, so that is actually our form of support. But when we look up, right, on this same ticker, we see that our highest point that we actually went to was here. And then the next candle reached this high, but then immediately rejected. So we had a reaction to our low of day as well as our high of day. And then as I pan over, we kind of hover in the range of our high of day gap fills, both upper and lower. For the upper gap fill, this is where price action has dropped dramatically with an obvious space between 2 candles. Once price action starts to trend upward, the close of the gap will serve as a resistance. And then for the lower gap fill, this is where price action has moved up dramatically with an obvious space between two candles. And when price action starts to pull back, the close of the gap will serve as support. So now let's discuss gap fills. And typically you'll see gap fills maybe on the daily chart. I've seen them on higher time frames as well. I definitely noticed them a lot more on lower level time frames. So we're just going to look at the 5-minute time frame on NVIDIA. This is going to be extremely helpful, especially if you are someone who likes to, trade gap fills. I have a very, very good trick, very good tip that I'm going to expose once I'm done explaining this. So a gap fill. So let's just go ahead and measure the point at which we gapped, right? So there is a gap to the upside, and I'm just going to go ahead and redo that. It didn't quite take. So we're going to measure this gap fill here. So right, there's almost a $5 gap. There's a $5 gap in price action to the upside. But as you can see here, there is a gap zone that started from right here. So if I just pan over, you see how we kind of pulled down to this particular zone. We were going towards that gap, and then we actually bounced to the upside. Now, if I actually scan over just a little bit more here, you'll see that we actually hit that gap, we bounced up, and then we played around in that gap fill zone, right? When it comes to support and resistance, everything is really a zone. It's something that can happen in that particular range, not to say at 427.50 on the penny, but in that range is where you want to pay attention to with all levels of support and resistance. So obviously we hit that gap, and then we actually pushed to the upside. So that's going to be when we gap, to the upside. We're going to go back sometimes and fill that. There's a high probability that all gaps will be filled. We can't say exactly when, but we also want to make, note of the fact that there is a gap on this chart that we may be looking to fill in the future, sometimes the very near future. All right, so now let's discuss the gap fill to the downside. Okay, so I'm going to just measure just to see how wide this particular range is. All right, so about an $8 gap to the downside. But as you can see, if I were to actually post a horizontal line from the point at which we fell, look at how price action just trends upwards. We almost fill that gap, and then we pull away, and then we eventually go to close that gap and then pull to the downside. So your gap fills are going to be levels of, in this case, resistance, and then the previous one that I showed, actually a level of support. So we want to be cognizant of those things as well, because we could actually hit that gap and then have an immediate reaction to it. So hopefully this helps. All right, so I know I mentioned that I have a very cool trick that I like to use when it comes to gap fills. So I know a lot of us have been watching NVIDIA. It had a very big jump in price action. You can see this obvious gap on the daily time frame. And I don't want to have to sit and watch this thing forever waiting in anticipation of it to fill the gap. So what I like to do is I like to mark the areas at where it gapped to, as well as the area from which it gapped from. And my alerts typically say something like gap fill zone. And so once that candle starts to, trigger that particular level, I can then get an alert to my phone or my email or even on the chart to tell me, hey, we're headed towards that particular gap. Now, that still doesn't mean to jump into the trade, but it definitely means like pay attention to the trend. Are we starting to, trend in that particular direction where we could actually fill that gap? And if so, then I want to be a part of that party, right? And so that's my trick. And then also I will set an alert like maybe the gap fill complete, because we do know that gaps are a form of support and resistance. So I don't want to just take my eyes off of it at any point, even when it's in the middle of this particular gap and starting to trend towards it. Never take your eyes off of it, because sometimes we can partially fill the gap and then bounce to the opposite direction. There are nuances to each subject we covered that will require you to think outside of the box. And there are also certain indicators that provide a level of support and resistance, like moving averages and Fibonacci sequences. But you'll just have to stay tuned for more information on those subjects. And if you found this video helpful, please remember to like, comment, and subscribe. And also follow me on Instagram at iCurlyK and Twitter at iCurlyK as well. Until next time, I'll see you in baggage claim. Bye.